Hey folks, so this lecture is about the relationship between international capital mobility and inequality. So let's define a couple terms. By capital, we're referring to either financial or physical capital that is invested so as to create an economic return. So a factory obviously is a kind of capital. Investing in stocks or bonds is also a kind of capital. And so one of the important things for us to understand is how the mobility of capital across borders, national borders, affects the power balance between capital and labor and government. And so let's look at this. Let's begin by talking about the two waves of globalization. So if you look at international trade, if you look at financial integration, if you look at migration, what you find is that there was an enormous growth in the degree of international interdependence economically during the late 19th century up until World War I. And in fact, by some measures, that at the end of that period was almost as or even more integrated than today. So there was a lot, especially a lot of capital moving across borders. Great Britain was, London became a financial capital and was channeling money and finance into the Americas, into Africa, into Middle East and Asia. And so there was an enormous movement of money and finance. Now, during that period, however, capitalism took what we call a laissez-faire form, which means hands off. Government played a minimal role. There was very small and inadequate welfare state domestically. The regulatory environment was very favorable to capitalism. We didn't have all of the health and safety and environmental and labor regulations we have today. Internationally, there were informal institutions like the gold standard or for international monetary policy, or there were free trade agreements, but we didn't have, it wasn't institutionalized in the form of, for instance, the World Trade Organization or the International Monetary Fund. It was mostly bilateral kinds of agreements across countries or informal kinds of cooperation. So you had a kind of raw capitalism where there were very few limitations on business vis-a-vis the labor or government, either at home or internationally. Now, that kind of capitalism led to an enormous growth of international and domestic inequality. Inequality rose dramatically between the wealthy countries of North America and Europe on the one hand, and much of the still colonized world on the other hand. And then inequality within countries, class inequalities between owners of capital and workers, also grew dramatically during this period. Karl Polanyi is a famous sociologist who said of this era that of 19th century laissez-faire liberalism, the conflict between the market and the elementary requirements of an organized social life provided the century with its dynamics and produced the typical strains and stresses which ultimately destroyed that society. What Polanyi is pointing to is that unregulated capitalism can be quite radical in many ways. Unregulated capitalism doesn't value community. It doesn't value tradition. It values efficiency. It values innovation, and it values profit. And so for societies that prior to the 19th century had been very slow changing. It had been, mired in tradition, and they had strong local communities. They were sort of torn apart by the growth of capitalism and the growing inequalities. You can see this, for instance, in the movement from craftsmen to factory labor, where uh, craftsmen had been highly skilled and made, let's say rocking chairs, um, or other kinds of items. Um, where they had a lot of autonomy, they had skills, they determined their own work hours, they decided how much to sell their goods for, versus becoming laborers on an assembly line in a factory where they have none of those things really. And so assembly lines are more efficient, but they also create a human cost. So Polanyi argued that it wasn't by accident that finally we had world wars, World War I and II. We had the Russian Revolution. We had the Great Depression. We had a contraction of international trade and finance, deglobalization, so to speak. So Polanyi was pointing out that really that 19th century laissez-faire capitalism was a victim of its own success. The more capital became, the more strength it gained, vis-a-vis labor and the governments at home, the more mobile it was, the easier it was to move around the world, the more destabilizing it was, and it led to counter movements, communism, fascism. It led to imperialist rivalry, and it ultimately led to economic collapse as inequalities grew so stark that they undermined the foundation of capitalist economies. So, from Polanyi's point of view, that kind of laissez-faire capitalism was kind of doomed, and it led to the collapse of globalization. So the question was, can capitalism be rescued? Can globalization be reconstructed in a more viable manner? Well, in effect, during the post-World War II period, there were efforts, and very successful efforts, to do just that. So fascism was defeated in the form of, Mussolini in Italy and Hitler in Germany, and the imperial system in Japan. Democracy and liberalism spread to new places. Communism wasn't defeated, but it was contained. That was part of the rationale for the containment strategy, is to prevent the democratic liberal capitalism world from collapsing into the hands of communist states. So containment was part of this picture, but it was mostly what countries did in the non-communist world to recreate a system that was more stable. Stability was prized over economic growth, and markets were basically regulated and controlled. So if you look at Franklin Roosevelt and Harry Truman, if you look at the social democratic parties of Western Europe after World War II, the goal was to create a balance of power among the state, capital, and labor, to create a social compact in which all three helped to offset the other, that there were countervailing powers to capital, that governments and labor both were able to balance against capital and prevent it from returning to a kind of unstable, laissez-faire world. A second element of this post-war social compact was the, an attempt to balance reopening the global economy and allowing growing international trade, but at the same time maintaining, at least in the beginning, controls on the movement of capital. This system was referred to by Gerard Ruggie as embedded liberalism. Basically, that laissez-faire capitalism was, the market sort of floating freely without constraint from the rest of society, and exercising power over all other kinds of social institutions. Embedded liberalism was the market embedded within society, that constrained by government, by labor, but also constrained to a degree by social movements and religious bodies and that sort of thing, so that the market would not be an end of itself, but it would be allowed the scope to operate only to the extent that it produced outcomes that were acceptable to a democratic society. And the ways in which capitalism was tamed, so to speak, were multiple, especially, domestically. If you look in the United States, for instance, we had progressive taxation to tax the wealthy at higher rates than those in the middle class or lower class. Collective bargaining, that labor unions were given rights to bargain for higher wages and even to go on strike. Social security, so that people had support during their old age or as a result of if they were unwell and had disabilities. Unemployment insurance, so that if you lose your job through no fault of your own, then you're able to get some support until you're able to find another job. National health care, not in the U.S., but in other countries, nationalized health care and made it a universal right. Universal education up through 12th grade, or at least 16 years old, required. That was to give working class families and their children opportunities to at least have a chance in the market economy. Financial regulation, the separation of investment banking from commercial banking, to try to prevent the kind of speculation and corruption that helped bring about the Great Depression and the stock market crash of 1929. And then finally, what's called Keynesian demand management, named after John Maynard Keynes, who basically argued that when there's a downturn in the economy, governments should spend more to boost demand and create a market for goods, rather than let factories just go under and unemployment to rise. So these together were methods to create a more equitable and more humane kind of capitalism. Internationally, what we learned during the Great Depression is that countries try to solve their domestic problems by putting up tariffs against imports, by engaging in what's called competitive currency devaluation, which actually, if every country tries to do those things, then everybody suffers. We also found that shocks or crises in one country in a highly integrated global economy can spread quickly to harm other economies. And so the efforts to reopen the global economy after the closures of the 1930s were taken with quite a bit of caution. The General Agreement on Trade and Tariffs began lowering tariff barriers, but included anti-dumping, escape clauses, other mechanisms, so that if a country felt that imports were rising too quickly or that they were subsidized by foreign governments, that they had remedies to protect their economies. There were also the, the exclusion of agriculture and services from the new trade agreements as too sensitive to exposed to international competition. Immigration controls remained pretty high, so immigration levels were low. Currency and capital controls prevented capital from moving easily across countries and prevented made it difficult to change currency from one currency to another. Fixed exchange rates served to prevent countries from trying to gain trade advantages by devaluing their currency and created the predictability and stability needed to carry out international trade. So it wasn't a rejection of globalization, but it was a more, what we might call a thin globalization, as Danny Roderick has referred to it. Now, John Maynard Keynes basically argued that growing trade was good, but movement of capital across borders or finance was destabilizing. He said loose funds may sweep around the world, disorganizing all steady business. Nothing is more certain than that movements of capital funds must be regulated. His worry is that the movement of capital across borders allowed capital to gain too much power. If capital can move across borders, it can pit governments against one another. It can seek out the regulatory environment that is most generous. It can seek out the tax systems that offers the lowest taxes on capital. It can move to countries where labor rights are fewer and labor movements are weaker. So since labor is not nearly as mobile as capital, yes, people do move and take jobs in other countries, but especially in mid-century, the ability to do that was much more limited than capital had been previously. And also because governments are not mobile across borders. They're territorial. Their laws extend only to the borders of their own country. So if labor and governments are not mobile, whereas capital is mobile, it creates an imbalance. So the only way to maintain a social compact that was fair and equitable was to place controls on the ability of capital to move across borders. An economist named Tiffin developed what's called the impossible trinity of monetary policy. It's relevant here. He basically said, look, there are three things that you might want to prioritize in monetary policy. One, you might want a fixed exchange rate because, as I said, it makes for predictability in trade. You know when you make a trade deal that the exchange rate's not going to shift and undermine the profitability of that trade. Also, governments can't competitively devaluate, which can lead to a kind of kind of pointless competition. So that's generally seen as a valuable thing. Sovereign monetary policy. That means the ability of a central bank in a country to control its own money supply. Doing so allows it to respond if unemployment's growing too much, they can loosen money and create more demand and stimulate the economy. If inflation's growing too much, they can contract money supply and try to bring down prices. So central bank control over the money supply is important. And then finally, some argue free capital flow is good on the grounds of efficiency, that the argument for it is that capital will be able to gravitate to its most efficient and profitable uses. And if those happen to be outside the country's borders, then the overall global economy will benefit if capital is not restricted to investing in less efficient, less profitable uses at home. The problem that Tiffin identified is that you literally cannot have all three of these at the same time. You have to choose two of the three and let the other one go. And basically what Keynes was arguing is that you should choose a fixed exchange rate, and you should choose to allow central banks to control their monetary policy. Those should be the priorities. And the only way to do that is to restrict capital flows. So you should have currency and capital controls to prevent capital from freely flowing across borders. He argued that if you allow free capital flow, it will undermine either fixed exchange rates or monetary management, and that would be a worse outcome. Now we can see that Keynes argued that trade was actually good, trade in goods as opposed to capital, and we see here exports of goods and services as a percentage of global GDP rose from the 1960 up to about a decade ago, when more recently it's flattened out. But the other thing that happened during recent decades is that the capital controls, which you'll see if you look at the red and blue lines on the left side where it shows advanced economies, you can see that there were fairly high levels of capital controls up until really the 1980s. And then they already gradually declined, and then they declined more rapidly in the 80s and 90s until they were almost, basically controls on the flow of capital across borders were basically eliminated by 2000. And so during that period, capital begins to become more mobile. And that is when we move away from embedded liberalism and back toward the kind of laissez-faire liberalism that we saw in the 19th century, with capital moving swiftly across borders and undermining the ability of countries to control their monetary policy, we abandoned the fixed exchange rates. And so embedded liberalism basically lasted from about World War II up until around 1980 or so. And then since then, we've been under a more laissez-faire system. And it was that period when Ronald Reagan and Margaret Thatcher both came to power in 1980. They both favored free market capitalism, laissez-faire capitalism. And they had some grounds. They pointed to the fact that by the 70s, the welfare states were becoming expensive. Countries were running budget deficits. But also there was something called stagflation, partly due to the oil crisis, where there were both usually unemployment's high and inflation's low, or vice versa. But now in the 70s, you had high unemployment and high inflation. And they thought that free markets would be the way to tackle those problems. So you see here that two waves of globalization and capital flows. You had capital flowed, the freedom of capital to flow across borders increased the late 19th, early 20th century. Then it declines from World War I through about 1960. And then you see it starts to increase. And in recent years, the increase has become quite steep. This shows at the same time global migration as a share of global population. The indicator to focus on here is the orange dotted line, which shows rates as opposed to just absolute numbers. And you can see here that that the global migrants as a share of world population actually declined slightly through about 2000 and then has risen since then, although at a far more moderate rate than the capital mobility. So labor has become a bit more mobile, but capital has become far more mobile. Because of capital mobility, capital is able to bargain for lower tax rates. Governments want to attract investment in capital, and they do that by trying to reduce corporate taxes. So look at the declines. These are different groups of countries, but they all show the same picture, which is basically that corporate tax rates have declined quite markedly in the last 20 years or so. The same time that capital is growing, capital is becoming more mobile internationally, tax rates are falling on corporations. There's modest increase in immigration. There's also declining rates of unionization. This shows among rich countries a decline from, looks like around 21, 22% down to maybe 16 or 17% over a period of just about, looks like about 14 years, maybe a little bit more. But if you looked at the United States, you would find that it's dropped much further. In fact, private sector unions are only about 7% of the workforce now. Now, one of the real consequences of the decline in the social compact, the passing of embedded liberalism, the growing mobility of capital, and we can see that capital is growing clout and bargaining power by looking at the relationship between productivity growth and hourly compensation in the United States. So the red line shows, increased productivity per worker hour. So how many widgets can a worker produce in a given hour, which is determined a lot by how much capital is invested and how much machinery and technology that the worker has access to. But notice that productivity increased fairly steadily from 1948 right up until the end of 2014. Productivity growth is pretty steady, and up from 1948 to the early 70s, you see that productivity growth and hourly compensation for workers increased almost precisely together. So workers, part of the embedded liberal bargain was that workers knew that if they went along with new technology, that they would get their share of the increased returns from that technology. And so the technology produces more efficiency, and the revenues rise, and workers get their share, capitalists get their share, everybody's happy. But notice what happens starting around the early 70s. Productivity is still going up, but hourly compensation flattens out. It barely increases between early 70s and 2014. Now, this is in real dollars, so we've removed the effects of inflation. If we had inflation in there, then it would look a little bit different. But remember, inflation doesn't increase your, if your wage increases 10%, but your the cost of your goods and services also increase 10%, you're not any better off. So it's best to look at real wages. So look at the gap between where productivity is as of 2014 and where wages are. Wages have increased 112% since 1948, but productivity 241%. Well, what's the difference? Where's the rest of that go? Well, that went to capital. It went to stockholders. It went also to upper management salaries, CEO salaries, but not to the workers themselves. you can also see it here. And if you looked at the blue line, which is advanced industrialized countries, this shows the share of national income going to workers as opposed to capital in the form of profits. And notice here that in the 1970s, early 70s, over half of national income went to workers, the rest going mostly to either government or to profits. And then, but look how much that declines by 2015. So workers are getting less and less a share of national income. If you look at the pay ratio between CEOs, corporate executives, and U.S. workers, you see that it starts out in 1980 at 42 to 1. It rises by the early 2000s up to more than 500 to 1. It's an enormous increase. Then it moderates a bit, but still by 2016, it's 347 to 1 compared to, again, in 1980, generation early, 42 to 1. Now, Thomas Piketty did a famous book called Capital in the 21st Century. And this is from his book. It shows the after-tax rate of return on capital versus the growth rate. And this is not precise by any means. He's looking at over enormously long time periods, but he's making a kind of best guess estimate. And what he's showing is that for most of human history, the return on capital, or you might think of it as profit on investment, has far exceeded the level of growth in the world economy. In fact, for most of human history, the world economy didn't grow at all, and most of the production that exceeded what people needed, workers needed just to survive, went to kings or to emperors or to feudal lords or to slave masters. And so it was a quite unequal world. But notice what happens in the 19th century. Starting especially in the late 19th century, the returns to capital decline, whereas growth in the global economy increases. And so there's this brief golden age, I guess, where, first around, right around the end of World War II, the growth rate in the world economy exceeds the profit level or the rate of return on capital. And once that happens, then average people, their incomes are growing faster than the incomes of the wealthy. And actually, that continues. The wealthy their incomes are growing as well up until about the 20 years ago. But notice the overall world growth rate was even higher. And so you actually had a period when economic inequality was declining significantly. And then look what happened starting again around, the early 2000s. The rate of return on capital continues to rise, but the global economic growth rate starts to decline. And still today, the gap between profit rates for corporations and for the wealthy and the overall economic growth rate is quite large. So if the returns to the investments of the wealthy are growing faster than the overall economy, that means inequality is going to grow as well. Well, so that's all I have for you today, and we'll connect it to some other themes in the course later on. Thanks for joining.